Managing Director and Head of Equity India with Macquarie Capital. Sandeep, fantastic to have you back. Thank you for joining us. It's just one of those patches where you need to fasten your seatbelt, because if you don't fasten your seatbelt, market volatility is going to hit you. 1,000 points off on Saturday, 1,000 point comeback earlier this week. Somebody's getting it right and somebody gets it wrong. But for the moment, I think the bulls are getting one day right, the bears are getting one day right. Whom are you cheering for, the bulls or the bears?
Well, I think you are right. There's clearly a lot of volatility, and it's unlikely that one set of people always get it right all the time. I don't think that I would be in the total bear camp. I think there are some challenges which we all know about, but the facts remain that I think both in terms of the global liquidity and in terms of what is happening in terms of bottoming out of growth, both of these are in the positive camp. So I would think that we can remain structurally positive on this market because elsewhere, the returns on other fixed income instruments will be much lower. So I would be in the bull camp, but I would not be very innovative, or I would say taking too much risks.
Like DMart or a Nestle going higher, which not only defies the law of gravity, but they also defy the law of valuation. How would you justify this price action? Now, we can blow a trumpet and say Nestle 67 times you don't make money, Jubilant 80 times you don't make money, DMart 100 times you don't make money. But the fact that somebody is putting in 4,000 crore and these are good funds, it just makes you wonder that are both of us getting something wrong on valuations? Do we need to go and open our school books?
Well, I think what has changed from what we learned in the school books and what we are witnessing right now is the global rush of liquidity which has happened in the last 5 to 10 years. The other thing which you also pointed out is that the expensive stocks are getting more expensive, and there doesn't seem to be any stopping for that trend. And the answer to that is actually in the first question, which is volatility, which you referred to. So there's so much volatility in some of the other names that if it is one stock which has done well over the last 4 or 5 years, I think the human psychology is to continue investing in stocks which have been going into a certain trend and believe that the trend will continue. Now, whether this trend will continue and break actually just depends upon what the operations are, and operations and the outlook on that stock may still be positive. My view is that these kind of stocks chasing this continuously at higher and higher valuations always exposes you to a risk which something changes in the market. So I would be cautious on these names going forward, but that's how the market is moving. Market is very risk averse, and therefore the stocks which have done well continue to do well in a risk averse environment which we are in.
Just to probe that point a little bit deeper, what's keeping your optimism on India or markets at large cap? Is it because the global dynamics are getting a little iffy? Is it because of India internals alone, or the expecting, rising valuations, or for that matter, the narrow nature of the rally itself? Or you feel that there are genuine signs that the bull market is somewhere fatiguing, not just with India, but across the globe?
So I think there are a couple of reasons that we have to look at. First, which I have mentioned, is liquidity. Global liquidity remained positive. In fact, the coronavirus situation has again added to the available pool of liquidity. I don't think any sovereign government in any large market wants any external impact to completely shake confidence. That has been the case since the GFC in 2008, that liquidity has been ample, and even in the current case, the Chinese government has decided to provide ample liquidity. So given that there's ample liquidity, given that growth has been weak across the globe, there is clearly a narrowing of the stock universe which people believe can withstand shocks, and that narrowing is something which is reflected in the way the markets are performing and the stocks which are performing. The only positive thing which I can say in addition to that, which is an India-specific factor, is that since the last 4 years we have had such a series of disappointments. I would say that now, at least from here till the end of this year, unless there is an external event, I think the economic growth and earnings growth in India cannot go down further. So I think people are still sticking to quality as far as India is concerned, But the belief is that despite all the negative news around the world and what's happened in India, growth in India is definitely bottoming out.
All right. Okay, so remain positive overall. That's definitely the sense coming in. But there's still an element of cautiousness, Sandeep, that prevails, with regards to investors going deep into the broader markets. When do you see that changing? We're counting on the rural recovery right now. That's what everyone's focusing on, even if we take that stand to start off with. When do you actually see the recovery coming in?
So I think the best leading indicator to see broader recovery coming in the markets is to see when the banking system credit growth goes up. We are currently at around 7% banking system credit growth. I think we definitely have had a lot of problems since the IL&FS event, and that has completely shaken the confidence in both lenders and borrowers. So clearly the system credit growth has gone down to a 40-year low. And that is reflected in broader GDP growth. That is also reflected in slowing of consumption, which we see. So if you want to go outside the highly valued and the safe, so-called safe sectors or performing sectors, then please look at the system-wide credit growth. If we see that going up from 7% to 10% plus, then I think other sectors can definitely deliver. If that doesn't change, then the sectors which are currently doing well, which is financials or the consumer sector, will continue to do well. So the market will be narrow as long as broad credit recovery growth is not seen.
As an investor, Sandeep, the bigger dilemma right now is that do you stick by with the leaders irrespective of how expensive they may be? Because they've been some of the best compounding stories on D Street, not just in the last 1 year, in the last 10 years or even before that. They've been the ones which have given you less heartache, so to speak. Or do you be a cowboy right now and try and bargain hunt within the broader universe, because that's where you will see high alpha generation whenever an overall recovery is to kick in, which seems to be happening at least for the last 5 weeks now?
So exactly my point is that if you see a broader recovery come through as reflected in the system-wide growth, then you can go for the higher quality small to mid-cap names. Right now, I think we are in the incipient stage or the beginning stage of these kind of a recovery. So you could probably see around 20-25% of your portfolio in these kind of names. But still, I think the bulk of over 50%, over 60% of the portfolio should be in large cap, well covered, well understood names, and that's where it should be. The only thing I'll caveat is don't go for businesses which are now trading at at some 8 to 10 times sales kind of valuations, and that's clearly something which is going to be much more difficult to justify when the market turns towards other stocks. But if there's a quality name in the financial sector, then that's something which can still be looked at, because the broader financial sector is also a reflection of the entire economy.
So, Sandeep, if someone has to invest the Macquarie way for this year, after a good start to this year, are we in for absolutely no returns? Because if earning estimates and valuations are anything to go by, the most optimistic estimate was that we will be in for 9 to 12% return, right? 9 being the bear case, 12 to 13 being the upper case. If that is the underlying case, then for next 10, 11 months, looks like we are in for flat returns, no returns, or at best 2-3% returns.
Okay, so as far as earnings estimates are concerned, we have seen that they've been wrong all the time. I consider most earning estimates to be a lagging indicator of what's happening in the market. Earnings estimates are actually just a confirmation of other broader trends that we see in the market. So I would think a 9 to 12% is just a safe kind of earnings estimate. It doesn't have any embedded information value. It's not telling you something new. There's nothing new that information is conveying to me as an investor. The one thing which I'll definitely see, that if we have inflation in the 3 to 4% range, we are looking at earnings growth in real terms in between 6 to 8%. If that is what you think is what the broader market is, then you definitely have to do much more hard work and identify businesses which give you at least real earnings growth in the 12 to 15% range. So that's underlying earnings growth of 17 to 20%. And those businesses are clearly need to be identified. And if those businesses are, let's say, in the financial sector or in the consumer sector, then you stick to those. That's the way to play it, at least in the first half of the year. When the broader recovery comes in, as I've indicated, then we can definitely shift in the small and mid-cap space.
Do you think there is scope for earnings surprise and peak re-rating? And where do you think there is scope for earning disappointment and earnings de-rating? We always focus on what to buy, Sandeep. Let's for a change today talk about what not to buy and where negative returns could come.
So the earnings surprise could come from the commodity side. I think in the commodity side, there have been a lot of concerns about slowing economic growth in China. But remember, one thing which is also happening in China is that there's a disruption of supply. So commodities could clearly be beneficiaries in India, and especially if the incipient growth that we are seeing in the economy continues to take momentum through the rest of the year. So commodities where the surprise is. Where could there be negative surprises? I think negative surprises could be in the NBFC sector. That's something which is still exposed to a lot of risk, both on capital adequacy side and on credit risk side. Negative surprise could also come on the retail side. I think everyone assumes that the retail lending side is going to be solid, and that's going to be the safest. That's where the negative surprise will be. And as I said, positive surprise could be in the commodities.
At your time, thank you for joining us. Over the years, what I've realized that there are two pockets where you always get a surprise. Good or bad, that's arguably, because consumers don't surprise you. Consumers, they always, in earnings, they always like 5% here, 5% there. HUL rarely gives you a scary number, or it rarely gives you a number which will make you start jumping with joy. You'll always get, in this context, earnings surprise from two pockets. One, commodities, good or bad, that's debatable, and corporate banks. Like ICICI Bank always disappointed you earlier, couple of years ago. Now they are surprising you. Commodities, couple of years ago, they completely were bombed out, and now they've started surprising you.